All right, so we've talked about the three different sections. We're going to focus on this first section, the operating section. There's two ways to prepare this operating section. There's two methods. There's the direct method and the indirect method. Okay, so that's what we're going to focus on now. Whichever method we use, they both produce the same cash flow result. It's just the path that they take to get there. All right. So this is now moving into topic 16.3, the two methods to prepare the operating section. So to prepare the operating section on your statement of cash flows. We're either using the direct method or the indirect method. Okay, the direct method lists the categories, cash inflows and outflows. Okay. The indirect method calculates the operating cash flow by starting with the company's net income. Starts with the company's net income and makes a series of adjustments. Oops. Again, regardless which method you use, both produce the same operating cash flow. All right, so there is one method that the Financial Accounting Standard Board recommends over the other. FASB actually recommends that companies use the direct method. They feel it's a little bit more user-friendly for the reader of the document, right? But we're still going to get the same result, right? So because of that, they let companies choose whichever method works for them, right? Causes them less stress and less time. So because of that, the majority of companies, about 98%, actually use the indirect method to prepare their statement of cash flows because it is a much easier method, especially if you have a lot of cash transactions or a lot of transactions in general. The indirect method is a lot faster. So that's the one that we're going to focus on in this class. That's the only one you'll be responsible for understanding. All right, so we said there's a series of adjustments. There's actually three. So your starting point is, of course, net income. That's your starting point. Then there's three adjustments. The first is to add back non-cash expenses. Okay, the most common non-cash expense you're going to have in this class will be depreciation expense. That's your first adjustment. The second is to adjust for any gains or losses. Okay, so you're going to basically do the opposite. If you have a gain, you're going to subtract it, subtract the gain, or add back losses. Okay, so subtract gains and add back losses. Why we do that is because we're trying to remove it from the operating section. Remember, this gives you cash flow from operations, from op activities. And we have said that, so these gains or losses, they come from sales of plant assets. Plant assets shouldn't be in the operating section. They should be in the investing section, right? PP&E should be in investing. So we're basically just trying to get it out of operating so that we can show it in investing. All right. And then the third adjustment is the trickiest. It is to adjust for changes in current asset and current liability accounts. Just changes. Asset and current liability accounts. not including cash. Okay, so excludes cash. And the reason we do that is we say we can really see all of a company's operations through their current asset and current liability transactions, right? Accounts receivable, accounts payable, wages payable. That's their core business operation. So if we just look at that change, we're going to be able to arrive at their cash flow from operating activities. Like I said, this third one is the trickiest. So there's a couple different methods to solving that. I'm going to show you the one I like best. And you're, of course, free to read the book or to find other methods online. The popular one is the journal entry method, but I'm going to show you the table that I like to use. So this helps you understand how to make your adjustments for changes in current liability and current asset accounts. So this is for the third adjustment. Changes, so adjust or changes in current assets and current liabilities. And again, we're going to make sure to exclude cash. Okay, so we'll have current assets on this first line and current liabilities on the second line. If during the year there is a change in balance, meaning they had an increase in change in balance, or they could have had a decrease, right? If you look at a current asset like accounts receivable, maybe this year we had, 15,000. Maybe last year we had 10,000, right? So the net effect is an increase of 5. So we had an increase in the current asset account of $5,000, okay? So what do we do with that item? We have to adjust net income for it, and the proper adjustment is to subtract it. Subtract it. Okay, let me explain why we would subtract from net income. All right, if we had an increase in accounts receivable, that would mean we would have to have more debits than credits, right? Because a debit increases the account. Now think back to our earlier chapters when we did journal entries. If we debit accounts receivable, normally our offset is sales revenue. If you credit sales revenue, that's also an increase. Okay, so this must have been what happened during the year. We had more of these journal entries than we did credits to accounts receivable because overall we had a positive change, okay? So now think about how this impacts net income because that's our starting point, right? Using the indirect method, we start with net income, okay? So think how this affects net income. An increase in sales revenue, that increases net income. Okay, so you're starting with a higher net income. But this is the statement of cash flows. Did we receive those sales in cash? Nope, we got them in AR. So that's why you were subtracting the change from net income. Okay, I call it like mental gymnastics. You have to think of all these things that happened. So I can assure you that each thing I'm going to give you in this little matrix here is true. It's proved, right? It's proven. You can work through the journal entries if you want, or just memorize this matrix here. All right, there is your helpful handy dandy matrix. We'll do an example in the next video so you can see this really working in action.